Money matters. Smart investing for beginners. When you're first starting, the concept of investing can be somewhat scary. Nonetheless, it is an essential component of accumulating wealth and saving money for a variety of different financial goals. Don't get too caught up in whether or not the current market climate is the right time to get started investing, because you will meet many different market settings throughout your investing life. However, before making any kind of investment, people who are new to investing should choose how much of a risk they are willing to take. You don't want to be taken by surprise after you've made an investment that carries a higher level of risk than others, and certain investments have a higher risk than others. Consider how long you can go without the money you plan to invest, and whether or not you are happy with the idea of not being able to access it for several years or even longer. Those who are just getting started in the world of investing will find these suggestions helpful. Number 6. Savings accounts that offer a high rate of return. One of the simplest methods to increase the return on your money beyond what you are earning in a standard checking account is to put it into an investment account. Standard savings accounts often pay lower interest on average than high-yield savings accounts, but high-yield savings accounts nevertheless give consumers regular access to the money in their accounts. High-yield savings accounts are typically opened through an online bank. If you are putting money away for a purchase in the next couple of years, or just holding on to it in case of an emergency, this might be a good location to put your money. Number 5. Certificates of deposit, more commonly known as CDs. CDs are another method to earn more income on your savings, but unlike high-yield savings accounts, they require you to keep your money invested for a longer period. You can buy a certificate of deposit, CD, for a specific amount of time, such as 6 months, 1 year, or even 5 years. However, in most cases, you won't be able to retrieve the money in the CD until it matures without paying a penalty. These are regarded as among the safest investments possible. And if you buy one from a bank that possesses federal deposit insurance, you are protected up to the maximum amount of $250,000 per depositor and per ownership type. Number 4. 401k, or one of the other retirement plans offered at your place of employment. This is potentially one of the easiest methods to get started investing, and it comes with several significant advantages that could be to your advantage both now and in the future. The majority of businesses will match a certain percentage of the amount of money you agree to set aside each pay period for your retirement. You are passing up the opportunity to receive free money if your employer provides a match, but you choose not to enroll in the plan. When participating in a standard 401k, payments are paid before income taxes are withheld, and earnings on those contributions are deferred until retirement age. Certain employers provide Roth 401k plans, which enable contributions to be made after taxes have already been paid. You won't be required to pay taxes on any withdrawals made during your retirement years if you go this route. Once you've made your initial selections, these workplace retirement plans will take care of everything else for you and allow you to invest regularly for the course of your employment, making them excellent instruments for saving money. A lot of the time, you even have the option of investing in target date mutual funds, which are funds that manage their portfolios based on a certain retirement date. To accommodate for a shorter investment horizon as the target date draws nearer, the fund's asset allocation will move away from riskier assets as the target date becomes nearer. Number 3. Investment companies and trusts. Mutual funds provide individuals with the chance to participate in a basket of stocks or bonds or other assets that they may not be able to easily assemble on their own. This presents a challenge for individual investors. Indexes, such as the S&P 500, which is made up of approximately 500 of the top corporations in the United States, are followed closely by the majority of the most popular mutual funds. Investors in index funds are typically subjected to very low costs, and in certain cases, they are not subjected to any fees at all. Because of the low fees involved, investors can keep a greater portion of the profits generated by the funds, which can be an excellent method to create wealth over time. Number 2. ETFs. ETFs, also known as exchange-traded funds, are similar to mutual funds in the sense that they hold a collection of securities. However, exchange-traded funds trade throughout the day in the same manner that stocks do. When compared to mutual funds, exchange-traded funds, ETFs, do not have the same minimum investment requirements, which are normally in the range of several $1,000s. ETFs can be acquired for the cost of one share in addition to any costs or charges that are involved with the transaction. However, if your broker lets you invest in fractional shares, you can get started with even less money. Either exchange-traded funds, ETFs, or mutual funds are excellent investments to have in tax-deferred accounts such as 401ks and IRAs. Number 1. Separately traded stocks. The purchase of stocks in specific businesses carries the highest level of inherent risk among the investment strategies covered in this article, yet it also has the potential to yield the greatest returns. However, before you begin making trades, you should think about whether or not it would be beneficial for you to purchase a stock. You should ask yourself if you are investing for the long term, which in most cases implies at least 5 years, and if you have a solid understanding of the company in which you are investing your money. When individuals own individual stocks, they frequently fall prey to the mentality of engaging in short-term trading as a result of the fact that stock prices are updated at regular intervals during the trading day. However, a share of stock represents a fractional ownership stake in a legitimate firm, and as time passes, your wealth will increase in tandem with that of the business in which you have put your money. Consider the more diversified approach presented by mutual funds or exchange-traded funds, ETFs. Instead of investing in individual stocks if you do not believe you have the knowledge or the stomach to ride it out with individual equities. Why should you get started in the investment business? Investing is necessary if you want to protect the purchasing power of your money and achieve your long-term financial objectives, such as retiring comfortably or amassing a substantial amount of wealth. If you keep your money in a standard bank account where they earn little or no interest, eventually inflation will reduce the value of your hard-earned cash and you will have spent it for less than it was worth. You can guarantee that your money will keep up with inflation or even grow faster than inflation if you make investments in assets such as stocks and bonds. While you are working towards making a large purchase, such as a car or a down payment on a house, you can increase the amount of interest you get on your savings by investing in short-term assets such as high-yield savings accounts or money market mutual funds. Stocks and exchange-traded funds, ETFs, are considered superior for long-term goals such as retirement because they have a higher probability of earning better returns over time. However, these investments also involve a higher level of risk. Important considerations for new investors: risk tolerance. Before you start investing, you'll want to understand your risk tolerance. Volatile investments, such as stocks, can make some people very uncomfortable when they decline, which can cause you to sell at the worst possible time. Know your risk tolerance will help you choose which investments are best suited for you. Financial goals. Establish both short and long-term goals that you want to achieve through saving and investing. Understanding your investment goals will help you develop a solid plan. Active or passive? You'll also need to decide if you'd like to be a passive investor or an active one. A passive investor typically owns an asset like diversified mutual funds or ETFs that charge low fees, while an active investor might choose individual investments or mutual funds that aim to outperform the market. Studies have shown that passive investing tends to outperform active investing over time. Do it yourself or hire someone. You can also choose to manage your investments through an online broker or hire a financial advisor to help you out. You'll likely incur lower costs if you do it yourself, but an advisor can be helpful for those just starting. Do you like it? Kindly give your valuable response in our comment section below, and don't forget to subscribe to our YouTube channel for more interesting and informative videos.